Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Zoom Communications. We're going to discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today we're going to look at Zoom Communications. Good old ZM is the symbol. And we're going to look at a FOMO trade. And we say that with a question mark because it's very hard in this marketplace to buy or sell anything. It's just a very confusing marketplace. A phrase that I heard an analyst say is, if the market doesn't go up, it still should have. And I think until we get some clarity about the geopolitical concerns, and we had another statement in that happened in politics about Taiwan and China. So we're just piling on to this situation. Obviously, if we could get a decrease in inflation, if we could see some decent inflationary numbers, that would be good. But I think the markets are going to continue to be volatile until we get a little bit more clarity on what's happening with the conflict in Ukraine. Is it going to continue? Is it going to take years before we get to a ceasefire? Or are we going to be coming to the table soon to start discussing an out plan as far as that conflict is concerned? Let's hope it's sooner rather than later. So with that said, I'm going to start by looking at my VIX watch list, and I'm going to talk just a little bit about the markets. But just in general, as far as the markets are concerned, just a lot of chop, a lot of confusion. We don't know where the marketplace is going to next. So on the VIX watch list, I have mentioned this many times. I really find it odd that we see the VIX trading right around that 30% level. There are talks of recession. I don't know. You could make an argument. Are we in a recession? Are we not in a recession? You can argue both ways. One good sign of the marketplace, because we don't want to make it all bad, right, is to look at the 10-year. The TNX is the SIBO interest rate index. It tracks the yield on the 10-year. And right now we see it at 2.738. So even though the Fed has been fairly aggressive in their rate hikes and in their wording, we still see the 10-year trading below the 3% level. And so that's a fairly decent sign for the marketplace. Still have extremely strong jobs numbers. Actually, I think the Fed would like to see the unemployment rate go up a little bit, showing a little bit slower economy. So those are the two things that are really driving the market. And if we look at the VIX index and we look at the chart of the VIX, I mentioned when we came down to the 4,000 level in the SPX, we didn't even really stop. We kind of hung out there for a day or two, but we never had that big spike up in the VIX. The highest that we've been, and that was just for a moment, was right around the 38 level. We never spiked above the 40 level. And if I zoom back out, brought this up a couple of times since the pandemic, there's only been a couple of times that we've actually even touched the 40 level. So I think that would really be help with the concept of capitulation in the marketplace. We need a strong down day that shakes the marketplace, see the VIX basically spike up, and then I would maybe start looking at trying to pick a bottom. So every Tuesday we do the show. So every Tuesday we pick a stock. It's not meant to be a recommendation, but we had some, well, I guess, okay news as far as Zoom is concerned. And they just announced earnings. All around it, though, every company is a big surprise. Walmart was a huge surprise, and we saw Target get dragged down by Walmart, and then Target came out and was even a bigger surprise, and it went down further. So these were a couple of the companies that should be doing well if there is a recession going on, and the bottom line is that supply chain concerns and basically stocking of supplies have driven both Target and Walmart stock down further when you would consider that might be a flight to safety. Now, Zoom, if we look at the chart, it's a very odd chart. It was the darling of the pandemic, which I don't know if you really want to try to tie your name to a pandemic. But if I pull up the chart on Zoom, and we're going to zoom out, pardon the pun, and look at it since the beginning of Zoom's life, since its IPO, we basically had this huge run up all the way up above the 600 level, only to see the stock come down precipitously. It did hang out. I think a lot of people were looking for some value down around the 300 level. They like the nice round numbers. But now we're all the way back to almost where it started. There weren't many days that the stock has been below 100. If I take my crosshairs and I kind of highlight that, this is right at the 100 level. We saw a little bit of resistance after their IPO at that 100 level. But once we broke out and made that strong move, Zoom never really came back until it did. We had a small bounce, little bit of a break below. We do not have our ducks in a row, but there's not a lot of stocks that do, especially in the tech world. We have the 20-day moving average below the 50-day moving average, below the 200-day moving average. Hence, in the title, the question mark, a fear of missing out trading Zoom. We had the earnings report. I think the marketplace took what was said as a positive. Zoom is definitely better off than it was when it IPO'd. There's been a lot of revenue that has came in. There are a lot of firms that have taken on Zoom as their platform of choice as far as a video platform is. The work from home situation is not going away. We see that workers are demanding the ability to work from home now. And a lot of the firms have seen that productivity hasn't really waned at all. As a matter of fact, some firms have thought that productivity has gone up when you allow their workers the freedom, the blue collar workers, to work from home. So there's still a lot of good things that happened in the Zoom world. One of the bad things about Zoom is that it's still extremely volatile. And look at this drop in the marketplace. Good thing we had a little bit of a bounce, but yeah, that has added volatility to the option contracts. We just had earnings. Should have taken some of the implied volatility because we had that known event that happened, but we still see large implied volatility. So I've had a theme here since the downturn in the marketplace about FOMO trades, about fear of missing out. We've gone back, we've looked at a couple of industries that should do well during the pandemic, or at least have been mentioned more than once. And one of them is the energy stocks. We looked at a fear of missing out trade, a FOMO trade in Marathon Oil. Another industry that you would think would do well in rising interest rate environments is the financials. And in that situation, this was going all the way back to the end of last year. We talked about a FOMO trade in the XLF, which is an ETF that tracks the financials. And with that FOMO trade, it's really a good example of why we would want to think about using options to manage our risk. The financials have done better than a lot of the other stocks in the marketplace, especially the tech area. Energy has done extremely well, right, relative to the rest of the area. Pharmaceuticals haven't done too bad, so maybe we should look at pharmaceuticals also in this environment. But we're going to try to catch a falling knife with Zoom. So how are we going to do it with options? On the FOMO trades that we talked about on Marathon Oil, which really has done well because it's a refinery too, with gas prices going up and also with oil going up, the price of oil, barrel of oil. If we're looking at Zoom and we're talking about a FOMO trade, because of the volatility and the marketplace, we're going to look at a different FOMO strategy. And that's part of the reason why I decided to pick Zoom as a stock today, because the stock play of the day is all about taking strategies from the options playbook and applying them to market conditions. we don't come on every single time and just talk about buying a long call or buying a long put. We come in and try to apply the 40 different strategies inside my book, the options playbook, to certain conditions and certain environments. So I want to take the time now. We're gonna look at an option chain in Zoom, and I'm going to talk a little bit about it because the chain definitely affected the strategy that I chose today. So Zoom right now is having a strong up day. Even after their earnings, the market was up, it was down, but now all of a sudden the marketplace has decided that, well, okay, maybe it's time to try to jump in and buy some Zoom. One of the things that's scary about it, though, and I'm going to show all the different expirations. We have weeklies, we have a lot of different expirations in Zoom to choose from. I'm going to stick with the normal monthly expiration, which is 24 days out. That is the expiration that expires on the third Friday of the month. And before weeklies and all these other expirations were added, that was the only expiration, right? And what has really changed the amount of expirations is computing power. There's a lot of quotes that go into quoting on an option chain on any underlying. So when the computing power was not there, when we didn't have the memory, when we didn't have that ability, they just only had once a month option contracts, and they expired the third Friday. Those contracts still live, and they're still part of the cycle. And I like to trade them when I can. That's because they've lived the longest. Weekly option contracts expire on a weekly basis, and they open a new one. They don't live as long as the monthly contracts. When a monthly contract gets opened up, it usually starts as a 9-month option contract and then eventually becomes a monthly contract, which that's what we're going to look at today. Why do I like that? They usually have more open interest. They usually have more volume. You have a little bit tighter markets. And that is an issue with Zoom. Zoom does not have great liquidity in the marketplace. Has to do a little bit with the implied volatility, with the fact that volatilities are so high, but it just doesn't have the volume to support as many strikes as it has. So we find bid-ask spreads to get wide. So I say that because that affects my strategy selection a lot. We see that the 24-day June 17th contract, open interest, we only have 16 contracts, so not a ton, but we did have 50 contracts that traded today. Looks like the 100 level has a lot of open interest, but if I look at the market, it's 760 by 90. It's 30 cents, and that's okay, especially when you're looking at an 81% implied volatility on that option contract. The higher the implied vol, a lot of times, the wider the bid-ask spreads would get, just because more volatility means more risk, and when there's more risk, market makers have a tendency to widen their bid-ask spreads. So 81% implied vol, we got a 30-cent spread. It's okay, not bad. Now, if I was doing a true FOMO trade, I would just look at buying a deeper in the money call option, like we did on Marathon Oil, if you want to go back and look at it, like we did on the XLF. But because it's Zoom and it has this volatility and a little bit less liquidity, we're not going to go out as far in time, and we're going to look at doing a long call spread. And we just want to get our ratios right in that we want to have more upside than we do downside. And that had a lot to play into this trade. And on top of it, if you do a two-legged strategy as opposed to a one-legged strategy, you're giving the market maker or the marketplace a buy and a sell. They have a tendency to fill you at better prices when that trade is already coming in as a hedge trade, as a package. So, because of all those reasons, my FOMO trade in Zoom is going to be a different strategy than the FOMO trade in the other two underlyings that I just mentioned. All right, so we're going to go out 24 days in time. We're going to buy the 98 strike that is just out of the money, and we're going to sell the 105 strike. In this scenario, that is trading for $2.78. Okay, so the width between the strikes is the maximum that the spread could trade for. So that's 7 points. We're just under $3 if we can fill at the midpoint, which I hope that we can. We have decent liquidity, but not great liquidity. So if we were to fill somewhere around the $3 mark, well, you're paying 3 to try to make 7. And I don't mind that ratio, and I set that up on purpose. Also, I'm looking to sell the 105 strike. I want to be within the range that the marketplace thinks the stock can go. How am I figuring that out? Well, I'm going to go up and look at the long straddle if we were to buy the most at the money option contract. And I'm going to round off here, okay? So the 96, well, it's now 97. The market is still moving. Wow, up 8.5% right now. So as we speak, the market is going up. So 97 is the most at the money strike. So you take 850 as the ask, and you take 845 as the ask on the put, and on the call, the long straddle then in this instance is around 17 points. If when we put on this trade, as you can see from where our market was, the market was down around 95 because these are the in the money option contracts. Market now has moved, so the 97 strike is the most at the money strikes, but you're talking about 17 points. Okay. So if you take 17 points and you add it to 97, you're looking at 104 as the upside. We're selling the 105 strike in this instance. So 197, 107, 114 would be the upside. Okay, so that's all the way up here on the 115 strike. So if I'm picking strikes on Zoom to buy and sell, I do not want to sell something above the expected move. I want the marketplace to think that the underlying stock can get to that price. Think of the expected move as the over-under by that expiration. If you think that it will move a lot, you go over. If you think it will move not a lot, you go under. And we want to make sure our strategy is that if it does go in our direction, that the marketplace assumes that it could get to our short strike. So we don't want to shortchange ourselves. We want to get a decent risk reward ratio, but we also don't want to go more than what the marketplace is expecting the underlying stock to do, more than a 14-point move. And that's what the marketplace is saying is feasible. Or I'm sorry, 14 point, 17 point move, 17 point move. I don't know where I came up with 14 at. Okay, so we're definitely within that range. This also means that you could probably slide up if you wanted to. You could maybe buy the 105 and sell the 115. Now you're going to lower your cost overall, but you're also lowering the likelihood over 24 days that the underlying stock could get to that price. So I don't mind that you adjust your long spread based off of your bullishness on Zoom, but I want you to be aware of why I picked the strikes that I picked. I picked the more at the money strike, the 98 strike, because I'm looking for some upside and I want a fairly wide spread. I'm selling the 105 strike because it's within the expected move. The marketplace thinks that it could get to that price. So we're doing this. We got a decent ratio. We're paying $275 for the potential to make 7. We have over $4 of upside on the trade, and that's going to be the official paper trade for this week. So let me put it in the right rail. And the only reason why we're doing this is we're bottom fishing. There's just not a lot of exciting things in the marketplace. We want to manage our risk. I would be a little bit nervous to buy the stock outright. I'd be nervous to buy almost any stock outright. I'd be nervous to get short any stock outright in this marketplace. So if we were thinking about buying 100 shares of stock, as opposed to that, we want to dip our toe in the water. We want to have some upside in Zoom. We don't want to miss out, but we want to have limited and known risk to the downside. And that's what the spread is accomplishing. Fear of missing out. If Zoom does make the bounce back, we want to participate in it, but we're not confident enough that we're just going to go on out and buy that 100 shares like we were anticipating. So now we're limiting our risk. Right now it's $265. That'll be the price. I'll click on it. Let's hope we can fill close to that price. $265 plus commission to put this trade on. And if we look at the profit and loss calculator, I'm going to highlight part of the reason why we're looking at doing a spread and some things that are, and why we picked a shorter time frame is that here's the Ally Invest profit and loss calculator. The strike that we're buying is 98. Strike that we're selling is 105. So we got 7 points wide. From 98 on down, we have limited and known risk to the net debit that we paid. On the upside, we have limited and known upside up to 105. But to start with, because volatilities, if I highlight it here, is 82%, it's really high on Zoom. To start with, we don't get a lot of benefit if the underlying stock starts moving in our right direction. And we don't have a lot of detriment if the market goes against us until we get some time decay. So I'm going to take this and I'm going to cut this down to 10 days from 24 days. And we'll see a little bit of movement in this profit and loss graph, but it isn't until we get closer to expiration. Let's go all the way down. I'm going to let's put in 1 day, that you will see the graph shift a lot towards the expiration graph, the dotted line. So if we're doing this trade, we want to be correct on our forecast closer to the expiration date if we want to maximize our profit. Now, if the underlying shoots all the way on up and it does the expected move, gets all the way up to 115 or so, then we'll get paid out faster. But that's also a very strong move to the upside. This is part of the reason why we are doing the 98 and the 105. That's well within that expected move if we are correct on our forecast. All right. Didn't ask for questions, but now is the time. If you have any questions, please put them in the chat box. We want to make this a very interactive discussion. Please share with your friends, family, let them all know. We do this live because we want to be able to address any questions that you may have. So I'm going to take the time to run over to the chat box and see if we have anything in there. All right, Clinton asks, how many standard deviations is the 105 strike? Okay. So a standard deviation, by the way, because Clinton asked, and that's a very astute question, is usually a little bit more than the expected move or the long straddle. I don't want to get into great pricing details about it, but if you are looking at a standard deviation move, it's usually going to be larger than the long straddle. Now, if you want to do it fairly quickly, a 1 standard deviation move, gosh, I don't want to get too complex here, but it'd be right about where the delta is 20. All right, so if we go and look at the option change, let me scroll up. And so right now we're selling a 37 delta. So another way that we could say this, Clinton, is there's a 37% chance at expiration, based off of the math, now this is all theory, that the underlying stock can reach our 105 strike price. Now, this is a little bit advanced for the stock play of the day, but the concept's there. It's just saying that there's a chance, right? There's a chance that it could get to this. You still got to be right on the direction, but if you are right on the direction, there's a fairly high probability that it will reach that strike if you are right on your forecast. It's a big if. Now, if I scroll out and I want to look at where approximately where a 20 delta is at, so we're looking at the 115 strike. So that between 115 and 120 is somewhere right around where a 1 standard deviation move will be, somewhere in that range. So if I'm thinking about this, a 1 standard deviation move encompasses 68% of all chances. So if you take the opposite of this, that means that on the outside, on the wings, there's a 16% chance that it could be above a 1 standard deviation move and a 16% chance that it could be below. Now, I went down this rabbit hole, so I feel like I wasn't anticipating to have that conversation. So if I just scared everybody, don't fret. We have it in the options playbook. So let's go into the options basics. What is volatility? And inside the playbook, we have about a 2-page read on what volatility is in all these standard deviation moves. Here's the graph of a normal distribution of prices. That's in the most basic form about option trading that talks about everything that I just mentioned. One standard deviation move, 16% would be above, and on the downside, 16% would be below, encompassing, if you add all these numbers together, you're going to come up with 100%. And that's how option traders, that's how market makers quote options. It's all about volatility and how that relates to probability. I've done many different seminars about these concepts, uh, just in general. All right. So sorry I went so far down the road. I hope that I'm sure that may have answered your question, Clinton. If you have a follow up, let me know. Anybody else have any questions? Please put them in the chat box, and I'll give you a couple of seconds. And if not, well, people are thinking about that. Click subscribe, please. Ring the bell. Give us a thumbs up. We'd like to get a little bit more support on the stock play of the day. So if you are interested in this, please share with your friends and family. And that's going to be it. Looks like for this edition of the stock play of the day. We'll be back this Friday for the stock play of the day overtime. We'll see how the Zoom trade is doing, and we'll go from there. Thanks for coming, everyone.